Welcome back to Fast Growth the Venture Studio A. I'm joined today by Guy Remond, co-founder of EHE Ventures, and Neil Vose, CEO of EHE Ventures Studio. If you've been following us, you know it's been a huge first quarter of the year. So for starters, our AI Growth Fund has made up to 6 deployments so far. And today we're just pulling back the curtain, telling you all about the companies we've backed, why we've backed them, the opportunities available to investors, and where we're heading next. So, Guy, Neil, welcome back to the show.
Hey, afternoon. Hi, Neil.
Great.
Okay.
Thanks, guys. So late last year, Guy, I'll start with you. Late last year, we officially launched the AI Growth Fund. But obviously, this has been years in the making. It's something that you and the team have been thinking and talking about for a long time, even before I came on board. So could you maybe tell the audience more about the specific gap in the early stage AI markets that we wanted to fill? And in your view, what risk did we run if we didn't fill that gap?
Okay, I'm going to do this as quickly as possible because there is a little bit of a story behind it. So this idea for the original idea was for a private equity company that was very transparent, did things very openly, and there was no kind of fine print tricks, should we call them, which sometimes goes on, right? So we wanted to be, solve that kind of problem. It was Gary Fletcher, my co-founder and friend, who we were both in Toronto actually on a course, on a program, and the following morning we were walking along the lake, and he sort of said, "Look, obviously I've had an issue in my past, and I'd really like to set up a private equity organisation, but do it in a really honest and transparent way." So we said, "Okay, well let's see what we can do." So to begin with, we were this is a typical startup journey, right? There's a couple of pivots coming up now I'm going to talk to you about. So we set the company up, and we actually then made quite a quick investment in an insurtech company called Peppercorn, which is a story for another day. And then we decided actually that there's no way that we could sit on the number of boards. We couldn't scale this in the way that we wanted to scale it. Our time wasn't scalable in the way that we wanted it, and our funds weren't scalable in the way that we needed them to be. So we thought, okay, so what we're going to do is we're going to build a platform, and we're going to be a middleman, and we're going to, through the platform, have entrepreneurs submit decks, which actually that platform still exists, and they still do. I think we had 400 over the course of the last 12 to 18 months. And the team look at them and identify the ones that look the most interesting. And we then contacted a whole bunch of investors who really didn't know who we were, which actually proved to be a bit of a fatal problem. But they agreed to come on the platform. The problem was that when we identified, interesting startups, and we sent them to those investors, the relevant investors, even though it was filtered, high quality deal flow, we were just another email in their inbox. We weren't well known enough, so that just wasn't working in the way that we wanted it to work. So then the final pivot really was to build a fund. And in the meantime, a company that I co-founded with my business partner Ian Brooks, that emanated from a software company, which was called the Startup Factory. And the Startup Factory, we worked on a sweat equity model. So we understood that most startups have big ambitions, and usually their ambitions are way bigger than their pockets. And we met a few actually while we were with Kate, and we helped a few, and we kind of tried this model in my previous software company. But when we got acquired, we pulled the IP out for this idea. And Ian, I was in an earn out, but Ian was able then to build a small team and a brand called the Startup Factory. And we worked with tech product startups, and we supported them by helping them build the software to an MVP standard. Great architecture, good engineering. We knew it was going to be high quality because we were investing in it, because we were doing some of this work on a sweat equity basis. So that's how the Startup Factory formed. Then we had this fund that we thought, okay, we're going to put together. In the background, we were beginning to build this team, and the team was actually a mix of some investment experts as well as a whole bunch of successful entrepreneurs and entrepreneurial operators, and it was a really nice mix. So to answer your question, the problem that we wanted to solve initially was to get funding for startups in the tech product space. What we ended up doing was building a venture studio, which is much more than just the funding. So we offer the tech capability still through the Startup Factory, which is part of the EHE group. We have the EHE Venture Fund, which again is part of the EHE group. And we have our advisory, EHE Advisory. Now, the three combined make the EHE Venture Studio. So we have a really unique combination that allows us to ensure that any investors that put money into our fund, we give that startup the best possible opportunity of being successful through the tech expertise we have, the entrepreneurial experience and expertise and contacts that we have, and the venture fund where we can support the startups at various stages of their incubation. So hopefully that's a slightly long-winded answer, but that's the answer to your question.
Well, thank you very much for that, Guy. That's quite a detailed history. Moving on to you, Neil. Fast forwarding to today, we have 6 investments in the fund so far in 2025. We've got Scooch, Subject, Phoenix, Spotlight, Goodwith, and Peppercorn. And I know you personally led the sourcing and diligence on most of these, if not all. So could you give us a sharp one-liner for each? Like, what had to be true for us to greenlight the startups?
Yeah, great question. I think what I won't do is do a short one-liner for each of the 6 and soon to be 7 companies in our first cohort. I'll tell you why, because it's half the reason. Because the founders have the narrative and the vision. It's a personal story, it's a human story, and they've demonstrated some initial business resilience and the right character to be a founder. Most people can't be founders. So it's a particular type of person that can bring alongside a particular type of team, which is an investable opportunity. Your question is all about what do we look for? Clearly, there's a big list of what we look for. I can actually simplify it by telling you what we don't look for as a primary. So we don't invest in the shiniest deck, the most detailed financial model. The business has won various competitions. For us, that's nice to have. It's not super important. What's really important is people that have really focused, maybe some bootstrapping, initial monies of their own, to build a POC, maybe a light MVP, to start to understand customers, to receive feedback and insight, which can really demonstrate opportunity and traction for a scalable business. So it's the people the people that focus on product and customer and development are most of interest to us rather than people building LinkedIn likes or social media following.
Mm-hmm. Great. That's a great answer. Thank you, Neil. And obviously, no matter how good the plan is, all first deployments are never smooth sailing. And even though we've almost closed our first tranche, if I'm correct, I'm sure there were a few bits, there were a few challenges, a few surprises that you probably didn't see coming. And when you were trying to get these first investments over the line, could you shed a little bit more light on that?
Yeah, listen, you're right. It's nothing's ever perfect. There are many actors involved in investment. There's us, there's founders, there's the co-investors, there's lawyers, there's accountants. I think as long as everyone comes into this process with their eyes wide open and with the right collaborative attitude, we get things over the line in a swift enough as possible timeframe. So I think what's been most pleasing for us, I think, actually, it's that word collaboration and ecosystem. A lot of the companies within our first cohort, we have co-invested alongside some other very well-trusted VCs and syndicates, and our ability to align with them. They might be domain specialists. So, for instance, working alongside a couple of traditional VCs that have a particular expertise in medtech and life sciences and agri-tech. We can partner with them as they're the sector experts. They actually quite like partnering with us because we're the tech and AI growth experts. It's that combination which I think particularly simplifies the DD process and the ability to make a decision about go or no go on an investment. So overall, I've been actually very, very, very surprised as to how smooth the process has been. I think guys got a comment in addition to that.
Yeah, so EHE stands for those that don't know, entrepreneurs helping entrepreneurs. That's the premises of our business. So what we want to do is we want to help entrepreneurs. Now, clearly, and I know we do, and we've had some great feedback. We really do help the cohort, the people we invest in. We spend a fair bit of time with them. We advise them. We do all that kind of good stuff. Where it's been really tough is when you get 400 pitch decks in. It's really hard, to not just to go through them and give them the time they need to have a look. But our principles are always to try wherever possible to give feedback. Now, I don't think we've been 100% successful, but the aim as we mature and we develop as an organization is to give feedback to everybody that submits an application into EHE, because we want to help entrepreneurs. We understand what entrepreneurs, the difficulty that they face. Investment can take so much time that it takes the focus off being able to build a business. We want to try and help with that. So if we can give some early feedback and guide them as to how they improve their deck, for example, or the way they present themselves, or the focus of what they're doing, then I hope that over time we'll be able to do more and more of that. We do try now, and I think we do to a good degree do that, but we're not perfect. So that's the area I think I've noticed that we find the hardest. It's just the pure volume and being able to do what we want to do, which is entrepreneurs helping entrepreneurs.
Thanks for that, Guy. And I think that just brings us nicely to the next question I was going to ask, either way, because I wanted to bring it to the ecosystem in general. Because one thing we always state in most of our comms is that we're not just a fund, we're a full venture studio. And of course, I think that changes the game for how we support some of these early stage businesses. So where do you think traditional investors get it wrong with these early stage AI startups, and how does our studio model fix that? Guy, I'll start with you, and then Neil, maybe you could chip in as well.
Yeah, sure. So clearly, the venture studio isn't all about money. Not just money. We want to give startups money to enable them to fulfill their vision. Good startups. But we're way more than that. Our tech expertise, because we focus on AI tech products and AI-led companies, then our technical expertise cannot be underestimated. So we can help them build the product, because quite often the entrepreneurs are not domain experts. They know way more about what they do than we'll ever know, but they don't really know about tech as much as we do. And it's one of the biggest risks in any tech product startup is the build. So if we can help with that, and we may end up building it with them and using part of the fund for that, or we may end up just lifting the hood and advising them, because they've already had something built, and maybe solving some of the issues that we find, help them solve some of the issues that we find, and then point them in the right direction as to how to do these things properly. Because building a tech product is really hard. There's loads of pitfalls. If you've never done it before, you can waste tons of money. So that is a massive differentiator. And I think also with the expertise we have within the company, we have a really strong team of investment experts. From our chairman, who is ex-LDC, 15 years, FD, Andy Grove, and then we've got, Neil kind of heads up the whole company, but also heads up the team, the investment team, which is, Jack, Troy, and Elliot as well. And, they've got oodles of experience in that area, can advise and make sure that investment's right for companies and the right type of investment and all that kind of good stuff. And then finally, I think we've got the sort of the people that have been there, done it, and got the T-shirt, either as founders themselves or as board members of teams that have taken an idea through to an exit. It's really important. Honestly, I've made way more mistakes than I have good decisions, but actually it's the good decisions that count. and people shouldn't be afraid of making bad decisions. You don't want to be reckless, but no one gets it right all the time. Everyone makes errors, honestly. My team will tell you, has some stupid ideas. But, you know, that's fine. Yeah, but, you know, realize quickly and move on, and either just adjust the idea if you just need a bit of fine tuning, or to be honest, sometimes you just completely bin it and go, do you know what? That was a really bad move. Let's move on. And so, you know, yeah, that's where I think venture studios differ. And the last point I want to make is that I actually think the market is moving towards more than money. I think Pretora have a slogan called "More Than Money," and I agree with that 100%. You know, it's not all about money; it's about what investors can bring to the party: subject matter expertise, technical expertise, entrepreneurial expertise, investment expertise. It's much more than money. And the great thing is that when people invest into our fund, because of all of that, we give our startups a much higher chance of succeeding. There are no guarantees. There's lots of things that are out of people's control that can happen. But we mitigate a lot of the risk that startups face. And that's what a venture studio is all about, in my book.
Great.
Yeah, just to wrap that up and to add to that, it was a great summary, Guy. I don't think it's a case that other more traditional investors are doing it wrong. They are much better at their own things than we are. But I think, as Guy said, we're about mitigating the risk, about investing in deep tech and in AI. It's hard assessing a valuation of a tech product if that's not your if that's not your comfort zone. The studio model gives us the ability to look at the initial valuation, the scale potential, and the budget requirements for taking an idea into production, into product, into traction, into scale, with tech, with accounting, with go-to-market. And that's not for everybody. It's quite a specialist skill. So I think it's people own and people sit comfortably in their various boxes. We're in that box, which is focused on pre-seed, through to seed, and Series A AI investing. And it's different. So it requires a different level of skills or different mix of skills, which is why, just to summarize, which is why the studio model, we believe, is more appropriate for the type of dynamics within the AI growth space at the moment. So that's why we're here. Yeah. And that's why we're doing very well in our first cohort.
Exactly. And I agree. Ultimately, it boils down to today's startups need modern capital, they need modern funding, they need a new kind of hands-on help, which is what we do. And so one final question before we wrap up for today. At the moment, I think there's a lot of noise out there. Some corners of the media world and, the VC world are already whispering about, AI fatigue. Almost every product or every company, every startup these days slaps AI in the front of it. So, but we here at EHE, we're obviously doubling down on AI. So what's your honest take on the AI investment landscape right now? And how does it validate EHE's decision to back these AI businesses, these AI first businesses? Neil?
I'll go first on that one. You know what? There's a lot of negativity actually around the investment landscape in this country, how it does or doesn't support entrepreneurs. I've got a slightly different take on that. I was actually hosting a panel at an investment event yesterday in Manchester, and there was consensus among 4 or 5 of us from the VC/venture studio community around, you know what, there's some really positive pillars which are building a really good foundation for AI investment and AI growth in the UK. Firstly, it's things like the deep tech R&D capability from universities and colleges. Manchester's a classic pacing point. So the whole host of innovation entrepreneurs come out of that, or potential entrepreneurs. I think a lot of those entrepreneurs are showing actually a deep, almost disrespect for disruption of traditional industries. Again, some of our cohorts are doing that at the moment in the medtech and the agri-tech space. It's fantastic. We absolutely back that. Again, despite what people say about the lack of public sector support, there actually is a growing emphasis within government co-funding departments, the likes of Innovate UK, in providing not just pockets, but quite substantial budgets for innovation, AI innovation. And then lastly, but actually the most important point, it's just the overall talent in this country. People coming out of computer science, out of economics faculties, they're showing much more of an entrepreneurial spirit than certainly I was when I came out of university. Well, there's many dark days ago, and I think that they just need some backing, some funding, and some help at that very early pre-seed stage. So I think that there's some pillars and foundations that are really encouraging at the moment.
Yeah, I agree. Guy?
I'm going to come at it from the tech angle a little bit. So normally new technology goes through a kind of a really high growth spurt when it comes out. People are like, oh, new shiny thing, and they throw loads of money at it, and it hits a peak. Then all of a sudden people go, oh, it's not that mature yet. How can we actually use it? How can we make money out of it? Then all of a sudden the investment drops in that area. And then actually then it starts to pick back up when it hits the base. And if you look at the way that crypto has behaved over the last few years, this is exactly what it's done. And now it's on a slower upward trajectory as people are understanding how to use it and where it fits into the world. So AI, I think, is different. So, Gary and I and Carl go to the Abundance 360 conference every year, which looks ahead sort of generally 3 to 6 years ahead. It used to be 15 years ahead. Technology's moving that quickly now. They've changed that to 3 to 6 years ahead because you just can't predict further than that. AI is going to be a lot smoother. So we have seen huge investment going into AI. The UK is actually the third biggest investor in AI in the world, would you believe, behind America and China. So we are up there in terms of our AI capability, the talent, and our awareness of what this is. But I think it's not going to hit the floor and then grow slowly. I think it's going to be a lot smoother. It might dip a little bit, but it's finding its place very quickly. People are understanding that it can make some massive efficiencies. And at the moment, we're in this great place where AI is beginning to be used because it gives huge scalability and capability, machine capability and scalability. And you combine that with human creativity and ingenuity, you've got that perfect mix. So again, I think that there are going to be job changes, but I don't think it's going to be anywhere near as bad as people are predicting, and it's going to take a little bit more time. And there'll be job changes, but there were when the wheel was invented, when the Industrial Revolution happened. Every part of human kind of progress, there have been events when the internet came along that have meant that certain jobs have become less important because machines do them, or the wheel carries goods instead of horseback and that kind of thing. I think AI is that, but on steroids. And we're beginning to find really practical uses in our day-to-day lives personally, but also in business. And it's an assistant at the moment. It's going to get more and more powerful, there's no doubt about that. And AI is actually at the center of the convergence of a number of different technologies. You look at how communications with super fast broadband, you can get a 2 gigabit connection to your house, 5G, soon to be 6G, super fast connections over the airways with your mobile phones and your devices. And then you look at compute power and cloud computing, and you look at, energy generation with, cheap renewable energy coming into the grid. So, which is cutting should over time cut the cost of energy. So it's this convergence of technologies, but AI is absolutely at the center of everything. It's controlling everything, and it will continue to do so and grow. So there are huge opportunities in the AI world. They shouldn't be underestimated.
Yeah, I agree. And I imagine over the we're already seeing a lot more exciting AI startups. And I think over the next few years, we'll see even more changes than we expected.
I'm going to make a statement. Any company in the next 5 years that hasn't adopted AI in some form or other, so it could be to run the company, to help them run the company, to improve efficiency by at least 70%, or in their products and services, will be either going out of business or out of business. That's my prediction.
Great. Thank you, Guy. That's a wrap on this episode. So, Guy, Neil, thank you for coming today. And if you're a founder building something exciting in AI, or you're an investor looking to back some of these exciting opportunities, drop us a line at ehe.ai, or send us an email at hello@ehe.ai. And thank you for tuning in to this episode of Fast Growth, the Ventures Studio A.